Traditional example, you have seen cases independent from policies. If you have a foreign company or trust owning, residence in New York or in Miami, if you want to get hold on the asset, if it's in the US, you can get hold of it, and you can locally decide that you disregard the foreign ownership, right? So just always a question: how many airbags, belts, you want to have on a solution? How secure that should be? And some want to go really far just to have that really solid.
Hello, everybody, and welcome to another episode of the ReSolve Riffs Investment Podcast. Today, I have a very special episode, something we haven't really done outside of investing or global macro, which we are known for in this podcast. Today, we're going to talk about some of the interesting solutions that are available to single multifamily offices, both in the US and offshore. And for that, we are joined with Riccardo Gambineri, President at Crown Global Life Insurance Group, and Frank Seneco, President at Seneco Global Advisors. Gentlemen, thank you for joining us and welcome. How's everybody doing today?
Good, thank you.
Great. So why don't we start with a little bit of your backgrounds. Why don't we start with you, Riccardo? Tell us a little bit about what your professional experience has been and how you ended up at Crown Global.
Yeah, thank you. So initially started my career in the financial industry and banking, investment banking, private banking, and later moved to business, even though it's really this kind of private placement life insurance business, which is kind of private banking for insurance, developing tailored solutions. Myself, I'm a business management and legal background, also tax and estate practitioner and private wealth advisor. So very experienced at working at Crown Global, responsible for marketing, product development, and especially focused on our high net worth, ultra net worth client segment and family offices. Just to be clear, we are the insurance company, so we don't manage assets, we don't provide tax legal advice. We structure US, UK compliant life insurance and a few other markets too. But most of the business is US and UK.
Got it. Okay, Frank, so tell us a little bit about your background.
Thank you. Well, I'm Frank Seneco, President of Seneco Global Advisors in New Haven, Connecticut. I've been in the financial services life insurance industry for 35 years. For the last 30 years, Seneco Global has been an independent firm. We service high net worth, ultra high net worth families here in the US and internationally on structuring sophisticated life insurance transactions for income gift and estate tax minimization. Primarily, the focus is on private placement life insurance. We do a lot of our work with Crown Global. They've been a great partner to work with.
Great. Okay. So, I've been wanting to have this episode actually for the better part of 10 years. We've been circling the drain on this area of solutions for ultra high net worth and high net worth individuals. And I've always found it fascinating, but a bit complicated. And it seems to be there are multiple solutions now, both for US, Canada, UK, and many other jurisdictions for tax planning using these products. So I'd like to start with just getting a broad understanding and a clear definition of what private placement life insurance is, private placement variable annuities, UK bonds, and what their similarities and differences are. I don't know who wants to take that one. But
sure, let me start. Maybe private placement life insurance is a term that's used around the globe, but has different regulatory meaning depending on where you are. Initially coming from the United States, private placement really is an SEC term for securities. Private placements means, and basically driven by the underlying investments. The PPLI tax rules in the US and many other places are the same like for traditional life insurance with an investment component. But the PPLI aspect is really like on funds business, it's a private placement. So you come with private placement memorandum. You can't offer it publicly. It's not widely marketed, not officially. No public offering. That's really the private placement aspect. Outside the US, in many markets, the term PPLI is more used, I would say casually, more than a marketing word, explaining that there's a bit more tailoring provided, that clients get tailored investment strategies instead of the predetermined investment options that most of insurance companies offer to their clients, but not necessarily a private placement. So in many markets outside the US, a private placement policy is really funding investments that are mass market retail, also suitable for mass market retail investors. That's really the big difference on the PPLI definitions, just to have a clear definition on the wording. What it means in short is really, it's a life insurance that insures the mortality, the premature death of a life, and it's combined with an investment component. That's really the very short of it. Frank, you want to add something to that?
I mean, exactly, as you mentioned, I mean, it's a life insurance contract, whether we're using it in the United States or abroad, and it has to meet the rules of the home jurisdiction that the client lives. I mean, you're utilizing a life insurance policy for the tax benefits afforded to life insurance. In the US, you have to be an accredited investor and a qualified purchaser to access the product. Other jurisdictions, it's a professional investor. But it's really that they are using it as life insurance with an investment focus.
Okay, so I'm living here in Grand Cayman, so I see a lot of different jurisdictions. I see Canada, UK, all types of Commonwealth nations, US as well. And in Canada, this would be very similar to a whole life policy, I would imagine. And the whole life policy in Canada is it's attached to an investment product that the insurance company itself manages. I find that in the private placement life insurance area, in the UK bonds, that there's a bit more flexibility as to what you can do with your money once you buy that life insurance, so whatever that premium is. So maybe we can start with understanding, I have some money that I want to set aside for insurance purposes, but I want to have a bit more flexibility on the investment side. What are my options here?
Yes. And Canada is a good example. Each country has different rules, what you're allowed to do with the policy, how much life insurance component you need in addition to the investment account. For example, if you put $100 in as an investment, as premium, in some countries, the insurer may be required just for tax purpose to pay the next day upon death $101. Another country, maybe in the US, $150, $200, $250 from day one. So these rules vary a lot. They're also depending on the country. They may have differences what kind of investments can be put or be invested in under the policy. Generally, you can't put existing assets in these insurance policies. Canada has very specific rules where the government sets the rules in a way that there are interest rates, crediting rates published each year, how much money you are allowed basically to earn in the policy and how much risk you need on top of it. So we were never able really to develop and provide a product despite many requests for Canadian taxpayers because the rules are so specific and seem to be limiting really the amount of cash, more limiting than in other companies, the amount of cash you can put in and how much return you're allowed to achieve in those products. But in essence, it's always a combination of an investment component and the risk. The UK is very simple. You can put in there's no real limit set how much premium we can put in. If you have enough money, you can start with $100,000 or British pounds, or you can put in 100 million. You just need to have 1% additional payout upon death. In the US, practically speaking, most products limit depending on the age, because the US rules, again, very different. the amount of risk determined in the US depends really on the amount of premium you put in total, the number of years you use to pay that in, and the age of the insured life and the investment return. So that depends on the age. That maybe the maximum premium is somewhere between 5 and 40 million. As older you are, as more you can put in, because it's also a saving and retirement logic behind from a social security thinking policy view. And as you're younger, you're not allowed to put as much in. UK doesn't have this limitation, for example.
Okay, so let's focus on that US side for a second, because I want to make sure I understand what you meant by that. So who are the people, let's start with, who are the American individuals and the reason why they would consider private placement life insurance in the first place? And then let's expand on what is doable if you have unlimited funds to put into it, and what the limitations of the use of the private placement life insurances are.
Sure. I mean, let me start on that. And Riccardo, please jump in. I mean, it's really, as I mentioned previously, in the United States, you've got to be an accredited investor and a qualified purchaser to even access into private placement. But as the individuals are high net worth, ultra high net worth individuals or families, family offices, where they're really looking to deploy what I call shelf money. It's money that's already been set aside in multi-generational trust, an example, for kids, grandkids, great-grandchildren. So they're going to let this money sit for a long time. But the type of deposits going into these are 10, 25, 50, $100 million going into these, depending upon the policy structure that we'll put together. Because under U.S. laws, we have to have a policy that complies for U.S. purposes. So depending upon if they're doing a policy domestically, onshore U.S., or if we did an international policy, there are different structures that we can put together to accommodate those premium contributions.
Okay, so let's talk about the difference between the onshore and the offshore options.
Sure. I mean, Riccardo, if I may still, please, as I said, jump in. But really, in the United States, it's very straightforward in my view. I mean, you have either we call a modified endowment contract, being it's a tax rule where we're going to have either a modified endowment contract, which is going to give you tax deferral on assets. If you put them into the policy, you're going to get a tax-free death benefit. If you make it a non-modified endowment contract, we get a tax deferral. We can borrow funds out without incurring taxation during the insured's lifetime, and you'll still get a tax-free death benefit. That's really the two structures you have in the United States for compliance purposes. If we're doing a policy for a U.S. citizen internationally in another jurisdiction, as an example, Bermuda, we can do a MEC, we can do a non-MEC contract. And Riccardo, if you'd like to jump in here, we have other policy structures that can be designed also.
Yeah, I think Seneco Global, we have life insurance companies in the US and outside the US in Bermuda and Cayman. And we're often asked, what is the difference? Why would a US person, for example, taking a policy issued out of Bermuda or one out of Delaware, for example? And then the other example would be if it's a US person living in the United Kingdom, for example, a US citizen. So the difference in the US, every state is regulating the insurance contracts, insurance commissioners, state by state. So even though you have a nationwide harmonized tax law, each state has slightly different rules on the contract level. So what you have to write in the contract, what you disclose, the insurance contracts have to be submitted, filed, reviewed, and approved. So once they're done, we cannot, for example, on a case-specific, client-specific situation, amend a contract language because the client or the client's attorney would like to have some extra features in the contract. So they're really very standardized, but different state by state. Also, the states have different, obviously, as known, different income tax rules, different state premium tax, depending on the product, whether it's life or non-life. And the investment advisors managing the investment portfolio, for example, also need to be licensed in the state. So if I want to have an asset manager, even a non-US foreign asset manager would need to have a SEC license, would need to be registered, for example, in Delaware, and we would need to get an approval of the asset manager and file the investment strategy with the insurance commissioner. So it's a very restrictive model, even though the investment strategies we can offer are very broad, but it's a very complicated process involving authorities. Now, if I go to Bermuda and issue a US compliant product from there, so the tax rules are the same. What the policyholder is allowed to do is the same. So just by going offshore, you can't do crazy stuff. The US rules still apply if you're a US taxpayer and want to have a US compliant contract. These things apply, but we have much more discretion there as an insurance company. If we onboard an asset manager and the US client, for example, says, I would like to use an asset manager in Canada or an asset manager in the UK or in Switzerland, we can onboard this manager. Of course, we do the due diligence and everything to ensure this is a proper company. We can design the investment strategy for the policy, and there is no US authority involved whether or not we allow onboard this manager. So I couldn't even use a foreign manager if it's not an SEC, as explained, SEC licensed registered manager in the US for a US.
Yeah, they have to have a license no matter what, but
correct. So
no registration required on the state level.
Correct. And if you have, for example, a strategy where you want to have a policy for enhanced asset protection or investment diversification, that you would like to have non-US securities, other markets that are difficult to access via a domestic broker-dealer platform in the US, you will probably use a custodian and manager outside the US that has a different investment universe, because the US side is very much limited to the US side of things. So these are the main reasons and differences between the offshore and the onshore. Also, another important example, like the US person living in the United Kingdom, the tax rules for life insurance in the UK and US differ a lot. For example, as I mentioned before, you don't need enough risk. But if a US person in the UK would buy a normal UK offshore bond, it would provide him tax deferral in the UK, but under his US tax filing, it would be treated like a foreign investment fund, taxed on a yearly basis. So no benefit. So this person needs then a policy that's designed to comply in both worlds, under the US rules, plus some additional language in the contract to include the UK terminology and the UK rules. Because at the end, you have also distribution rules, disclosure rules, what you need to put in the contract for a UK resident. In Bermuda, we can do hybrid contracts, basically a contract that merges, integrates two different jurisdictions. In the US, you can't do that. So the insurance commissioner will only approve a US domestic contract. They don't know anything else. It's not foreseen. So there are a lot of reasons why you would want to go offshore for certain use cases.
So can I just, if I'm an American citizen living in the United States, what would be the reasons that I would choose a domestic product over an international product? Because right now, it feels to me like there's plenty more advantages in Bermuda, but are there clear-cut reasons why I would choose as an American citizen to just stay domestically rather than offshore?
I mean, initially it may be it's a little simplicity. I mean, if they would just want to work with a U.S.-based manager. They have their estate planning already set up, structured in the U.S. They've already set up multi-generational trusts in South Dakota or Delaware, and they just know they want to use a U.S.-based manager. It's very straightforward. As Riccardo mentioned, I mean, and you alluded to, there's a lot more options in going internationally, accessing different managers, international investment options. But for U.S., it's very straightforward if they just want to stay more plain vanilla. Riccardo, do you have anything to add?
That's exactly true. So if the client is just happy with everything that's been offered domestically, there is no need to go offshore. The offshore policies obviously also require additional tax reporting. I mean, there's no tax due as long as no money is coming out of the policy, like on the US side. So the product rules are the same, but there's additional filings to be done. There's a FinCEN form, a foreign asset report the client has to file. So if the client typically doesn't have any cross-border activities, they may not feel comfortable having offshore exposure. On the other hand, if you want to do, take the reasons why somebody goes offshore is really enhanced asset protection, creditor protection. Bermuda provides statutory creditor protection, so the beneficiaries, creditors can't access really policy assets. There's no limit. Like the US, depending on the state, some states have different kind of creditor protection limits. Some states have a few hundred thousand, but in Bermuda policy, there is no limit. So as long, obviously, the policy wasn't issued and set up in a fraudulent criminal context, then as long as the beneficiaries of the policy are family members, the spouse, the children, no judge in Bermuda will grant access to the money to creditors. That's one thing. If you have a job, a profession like an attorney, like, plastic surgeon, physician that is fearing litigation, US is a super litigious environment, you may want to put some of your assets offshore just to ensure that you have a safe nest egg that's very difficult to reach. And especially in the last years where the rise of litigation funds that billions of dollars in funding every litigation, they also operate with probabilities and business cases. Our statistics show that the typical litigator will always prefer domestic target, a domestic structure. It's much easier to reach and to convince a local judge, court to do something than going to an offshore jurisdiction. You typically have to pledge money at the court before anything happens. It can take years. So whenever you have proper planning reasons, these are aspects. Or you...
Very interesting. I did not know that was an issue. And of course, you have a ton of incentives for the litigation funds to try to maximize their profits and also minimize their risk. So very interesting point. Okay.
And it's interesting, just if I may, as Riccardo mentioned, it is very important to know that there are reporting requirements for U.S. individuals taking out a policy internationally. But that being said, with a legitimate reason for the planning, doing it properly, it's more than worth it. I mean, it's what my point is. I mean, some people get a little nervous by that, but it's very straightforward. Most of these transactions are done with very high profile tax attorneys, CPAs, who more than incorporate that into the planning.
Correct. And also, as we spoke about the investment, asset diversification, asset protection, obviously one thing is the structuring and the difficulty to reach in litigation cases. The other thing is portfolio diversification, investment diversification. And we see, especially the wealthier families and family offices, obviously they all super heavy invested in US, but prudent approach is that certain assets should also be outside the dollar, outside non-US investments, non-US funds, these kind of things. And in the context of asset protection, you even, of course, also not only want to have the offshore policy, maybe an offshore trust, but you also want to then have an offshore custodian asset manager. Otherwise, if you have the stuff offshore and all the money is sitting in an account in New York or somewhere, it's still only a half-baked solution. But just from investment portfolio diversification, we have a lot of US clients, very wealthy clients, that use asset managers in Canada or in the UK or in Switzerland that manage parts of their wealth just completely non-correlated to the US market, just to diversify. That's also one of the reasons. And again, that would be difficult to achieve from a domestic policy, as mentioned before, because it's difficult to link in the foreign providers in the US net. And some of them even don't want to be connected to the US from those managers.
So that's interesting. Even if the policy is offshore, if the custodians are in the US, that creates an easier path to freeze assets and things like that. Is that what you meant?
Yes. I mean, traditional example, you've seen cases independent from policies. If you have a foreign company or trust owning, residence in New York or in Miami, if you want to get hold on the asset, if it's in the US, you can get hold of it. And you can locally decide that you disregard the foreign ownership, right? So, just always a question, how many airbags, belts, you want to have on a solution, how secure that should be. And some want to go really far just to have that really solid.
So just to kind of finish the thought here on the US policies, I want to understand the limits a bit more. So you said the older you are, the more you can contribute, the younger you are, the less. Aside from age, what are the limits and why do they exist?
I mean, there are a lot of technical rules setting these formulas, but the political reason, at the end is always it's policy, right? When the Congress sits together, and the last time they made a major revamp of these rules was in the 80s, it's already some time ago. They just said, okay, there are limits how much somebody should put in these products because there are so many tax benefits granted. So they want to support that, from the very low income family to the wealthy, that they're able to put money aside, protect the family with the additional insurance, protect against premature death. That's why over time we're allowed in the US to reduce the amount of risk more and more to reduce the cost. But the thinking is you're building up a wealth and you want to protect or leave a legacy for the next gens. But as we said, there's tax deferral. If it's paid upon death, all the gain is not subject to income tax. So you have a step up and no tax. You can borrow from it. You can use a policy to collateralize it. So there's so many tax benefits. It would be obviously not good public policy to say you can put $1 billion in, right? That's not really fair to the rest of the population. So it's a very generous offer, but there have to be naturally limits. That's
so. Just to recap,
see this in other countries too. Sorry, just to finish that. So, in many countries have the one or the other form of limitation.
Sorry to interrupt, but I did want to take a quick second to remind listeners that while we do absolutely love providing our audience with world-class guests and weekly investment insights, we wanted to remind you that we actually do our best work outside of this podcast. And we try to do this by providing cutting-edge, globally diversified, and systematic investment strategies that are designed to be broadly non-correlated to traditional equity and bond portfolios. So we actually manage private and public funds, as well as bespoke, separately managed accounts for investors that seek the potential to smooth out portfolio returns in the long run. So if you do want to see that theory that we've been talking about put into practice, please do go ahead and check us out at investresolve.com. Now back to the podcast.
Okay, so just to recap on the US side is obviously it's a public policy perspective that allows for the limitations, but what money you are able to put in aside from the cost of insurance and the cost of management and all that we'll touch upon in a second, the flexibility of that policy, whatever you can put in, is one where you can somewhat direct what investments third-party investment managers will manage that money for that insurance policy. And then you do have access to it in the way of being able to borrow against the policy. You're also able to use it as collateral for other reasons, whether it's business or personal. So it provides that level of flexibility. But I guess when you borrow up against a policy, you are borrowing with some sort of cost to borrow against the policy. Is that right? It's not. There's an interest rate that you would, and would you borrow with the insurance company directly? Or how does the borrowing work for those contracts?
Frank?
Sure. Well, yes. I mean, what you're doing is the policy owner would go to the insurance company and they're going to borrow out 80 up to 90% of the cash value if they needed to access it. The insurance company is going to charge an interest rate for that. Don't forget, I mean, the reason being is we've got a tax deferral during lifetime. So you paid no taxes on the growth of the assets inside of the policy. So we need to legitimately borrow out the funds and charge an interest rate to keep that from incurring any taxation. Riccardo, what's the interest rate that right now that we're charging at Crown for a loan? What's the net?
I would have to look up, but in US context, the IRS, Internal Revenue Service, publishes the applicable federal rates, depending on short, midterm, or long-term financing. And those we have to use at the point of time when the borrowing happens. They are used for all kinds of things, whether there's an intra-family loan or you borrow money from a fund. So the IRS publishes rates that are just set to ensure they are market arm's length, market standard. So we use those, and depending on the interest rate environment. And it's a requirement by the law. So for us, it doesn't really matter. Insurance company is not a bank, so we don't really, if you have a policy and you want to have $1 million out of that, we don't take that out of our pockets. What practically happens is that we liquidate assets in the investment account of your policy to free up the 1 million, and then we hand that out. And on those, we book this interest, apply the interest rate. We have to make a little margin on it. That's a real transaction, and the difference is credited back to the policy account as an accounting exercise. So it sounds strange, but that's just the rule, how it works. And provided the policy runs until death, that's a key thing in the US tax planning, the outstanding loan is netted out with the death benefit. So it disappears basically with the death, but it needs to run until death. Otherwise, you have, if you would, let's say, cash out the policy during lifetime, then the loan would be treated like a distribution, obviously, is to a large extent taxable. But typically, nobody would do that. So you take only as much money out of a policy that the policy can run until death with the insured amount, and then it's netted out. So
right. So that's upon death, you pay the bills, and whatever's left, the family receives.
Correct. But you're getting that income tax free. So, I mean, if you've gotten the dollars out, through the loan, you haven't paid any taxes, and then the loan is paid off upon death with the balance of the death benefit that's left over, and that's going to be come to the family tax free. I mean, it's really, we have this come up all the time with clients. Well, why am I borrowing against, my policy? This is the standard rules for U.S. life insurance. So it doesn't matter if it's a whole life policy issued by an old mutual insurance company that's brand name. I just don't want to go into any names on this podcast. To a private placement life insurance contract. But you've gotten this where we've got this deferral during lifetime. I mean, if the client, as Riccardo alluded to, if the client just wanted to take money out, they surrender their policy, they're going to pay ordinary income taxes over their basis in the contract. The loan is under U.S. law, you're allowed to access those funds. So we access those funds during lifetime. My hurdle rate there really is the net loan interest, which is very small, that's going to be charged. And then upon death, we get that back as an income tax-free benefit anyway.
Yeah. And as you were asking, what can be taken out? So obviously, the tax rules are quite clear. In the US, it's called investor control doctrine. In the UK, it's different. In most countries, you're required really to fund the policy with cash. So you can't do what sometimes the myth and the Wonderland stories that are sometimes reading, or misconceptions that are floating around. You can't put your existing investment portfolio in, or your closely held company shares or whatever, or wrap your private plane. That's not really, could do this, then it's a defective contract. It may have other benefits, but no tax benefit. But if you want to have these tax benefits, cash in, the asset manager that is appointed has to manage discretionary. So you can't call the asset manager. Yeah. And that's a key requirement. So there are a lot of requirements. That's why all this, you said at the beginning, sounds all very complicated. yes, there are a lot of complicated rules that need to be followed to get in. So as said, investor control, you cannot just decide yourself the investments. But once this is set up and all the contracts are established, there's no complexity. It's really easy. You reduce a lot of investment, account, and tax reporting for the policyholder. If you're in the US and you invest in all kinds of investments, you deal with tons of K1s, you have a lot of ordinary income producing things. And so this all disappearing. So you don't need to pay your accountant to make all this. I mean, we know clients that pay hundred thousands just for the investment accounting yearly.
Yeah, I agree with that. So in the US, once you have your money in, and let's say the key thing that you mentioned that I just want to make sure is clear is that you can't deposit cash in and then start trading stocks yourself, right?
Nope.
The idea is that you are handing the fiduciary responsibility to the insurance company, but within, and the different insurance companies will offer different offerings, but within that insurance company, you can select a discretionary manager to manage those funds for you, or maybe a handful of discretionary managers. Is that right?
Yeah, we have about 100 managers on the list you can select from, from whether you want to pick, all the big brands are on the list and also some smaller ones. So whether you want to pursue endowment-like investment strategies, private equity strategies, or just, high-frequency trading strategies, there are all kinds of strategies available, and you can elect from those, ensuring that you get the risk, asset, and return exposure you like, and avoid overlap with other existing strategies. Obviously, that's important because the policyholder bears the investment risk. There's no guaranteed returns, and that's why you have, at least to that level, the control that you can guide where and how the money shall be invested, without going to the individual instrument level, because that's
right. So that's a key differentiation. You can't select the individual instruments and when and how to trade them, but what type of flexibility does one have to change the portfolio manager risk, right? To change the mix, between, I like 3 managers that I chose within a platform. Next year, I want to add 2 and take out 1. Is that still within your power to do so?
Correct. That's obviously different companies have different rules because it's mainly an operational efficiency and service level question. We at Crown Global allow you to do this every 6 months. So if you want to change all the managers on a platform or the custodian, you can do that without charge. And we're very flexible and open architecture. Other companies may have much more limits or want to have a charge for that. But the key thing is, generally, it's possible. And the other key thing is, whenever you do these asset reallocations, manager changes, it all happens without incurring taxable events. That's the key thing, especially in the last couple of years, as we have seen these super high volatile markets, where also now active management becomes also much more important, not only interesting again. The 10-year phase where people just said, I only buy if you index, then I'm surfing on the growth wave, that's gone. So we see this since a few years. And active managers, they have typically one problem. Assume the manager knows exactly what he's doing and why and how he's investing in certain instruments. He always is constrained by, okay, if I do this now, what is the tax hit for my client?
What is the tax implication? Yeah.
So, and they invest a lot of time and effort and cost to make investment strategies tax efficient, but still they're very much limited on what they can do and how fast they can act proactively or react on the market, depending. In the policy, the asset manager can just manage because he doesn't need to care about the tax implications. There are no tax implications. Whether you make 50 or 100 buy and sell transactions, there may be execution costs, but there's no tax concern, right? So
this is a key benefit I've found from these policies is if you're buying the S&P 500 long term in an ETF, you're already getting that tax deferral. So far, right? Things can change. But you get that tax referral, there really wouldn't be a lot of benefit from a tax perspective to buy an insurance policy. But it's when you get to active management. I agree with you, Ricardo, and from your mouth to God's ears that the next decade will be the decade of active management, as I am an active manager, that you do give yourself the flexibility to do what's right from an investment perspective rather than having to weigh the tax consequences. And I do find that is a key benefit of the insurance policies. If you will lean towards active management and active managers, it is a great solution.
Yeah, and reality is a lot of the clients and family offices we serve, of course, they all have the overall portfolio is very diverse, and you want to have liquid strategies. Of course, you want to be listed equity markets exposure, but you also want to have non-correlated asset classes. You want to maybe participate in the credit market. There are some great funds and managers. You have all these assets that by definition are not tax efficient. Some of these produce great 10, 12% return gross, and after tax is less than half. If you're living in New York or California, even more than half is gone. So it's very difficult then from an overall perspective, portfolio or asset allocation perspective, to create really a nice overall portfolio and using all these asset classes. And that's another benefit of the PPLI, that you can really also go into these asset classes that would be otherwise very tax inefficient, even though they're very good for a stable portfolio and return to diversify.
So Frank, just out of curiosity here, when you're creating a policy and funding it for the first time, is an investor able to do a transfer in kind of assets to pay for that policy, or is it a cash only transaction?
Typically, it's going to be a cash only transaction. I mean, in the US domestic policies are cash only contributions going into a policy. In some international jurisdictions, which Ricardo could speak to better than myself, some countries will allow that. Again, totally different rules, but US domestic policies are cash contributions going in, and then we'll elect the investment manager to invest the assets.
Yeah. Okay. So there's the individual that kind of put us together, Homer Smith, he deals with a lot of new entrepreneurs that just kind of cashed up, and that's clearly a great time.
Yes,
to start using these policies for financial planning. But I guess there isn't some sort of rollover where you can roll over without tax consequences, anything that has embedded capital gains in there too.
Yeah, I mean, moving an asset in kind would it's going to create taxation. Yes, it's a recognition event because you're changing the ownership. Really, you're not owning the asset any longer. You're transferring that to the insurance company. So, and as I said, in the US, it's cash only contributions.
Yeah.
Okay.
Really, these two aspects. It's a recognition event because you don't own it anymore. The insurance company takes the ownership. And by that, you have to tax it at fair market value and appreciate. The second reason why, again, as mentioned before, is against it is the investor control. You can't move in, contribute pre-selected investments because then you already made the investment decision, which is against these investor control rules.
Okay, so can I move on to the UK bond? We have a lot of UK interest here in the Cayman Islands. And tell us a little bit about the key differences between what we just discussed and the UK bond and the onshore, offshore versions of it.
Yeah, I mean, the onshore, offshore version, UK onshore bonds are much more retail mass market solutions. The offshore bonds provide typically more diverse offering of the investment options, but the rules are the same in UK to that extent that you have to fund with premium in cash, so you can't contribute existing assets either. The rules are the same to that extent. The difference is there's no MAC or non-MAC rules, so you can just fund with a single premium if you have the money at hand, or you can fund it over several years. Where it differs a lot, you can't use the UK bond onshore, offshore, doesn't matter, because again, like in the US context, whether the policy is issued from an onshore or offshore company, the tax rules as laid out by HRMC and common law in the UK, they are the same. So either you comply or not. You can't use that product to collateralize it. You can't take a policy loan. They always would be treated immediately like, from a tax point of view, like a distribution, like a taxable distribution. Also, the way you can access money is different. Again, there are no MAC, non-MAC rules. So if you pay in money, all money paid in within a given year starts a 20-year cycle. Basically, you're allowed to take up to 5% of the premium you paid in per year tax-free. It is rolling forward. So if you don't redeem any money, let's say 10 years, then you could in year 11 take 55% in one go out of the policy without triggering a tax event. So basically it's access to your basis, your premium. Obviously 20 years by 5% makes then 100. So after 20 years used, then you don't have any basis left, and whatever you take thereafter is really taxed at ordinary income rates. Because
okay, I want to make sure. Let me just rewind, make sure that I understand what you just meant.
Yes.
Sure.
So you have $10 million. You put it all in year one. There's no limit as to how much I can put in, as you mentioned earlier on the podcast, right? So I put $10 million in. By the end of that year, I'm allowed to take up to 5% of that $10 million if I wanted to. Is that right?
Mm-hmm.
Now, let's say that $10 million turned into $15 million because of appreciation from the investments available. Am I allowed to take 5% of the 15 or only 5% of the initial premium?
Of the initial premium.
And then what you are taking out, would that be return of capital basically, right? You're not touching, like another thing that could happen is you have a $10 million investment. By the end of the year, it's worth $2 million, right? You lost 80%.
Yeah.
So is there capital gains and losses available for you? Like how does it work for whether when it comes to losses or gains and what you can take out on a yearly basis?
A good question. All these advantages these policies in US or UK provide, and the rules in that context are the same too. There are rules how it's taxed when money comes out. If it's taxable, it's ordinary income. It's the same in the UK, it's in the US. If you made losses, you can't net them. So that's a difference to a directly held portfolio that doesn't exist, right? So that's a downside. But if the assets are managed well, and typically they are managed well, we haven't seen cases like that really, that somebody is losing so much money. But yeah, you can't offset the losses. That's very short answer, very easy. They're designed for long-term holding and eliminating ongoing taxation until money comes out. And in the UK, you have this allowance that you can take out first your premium basis, and then thereafter you can, if you take out more, then you tax the income basically.
Right. So if you do, you are able to take more than your initial premium if you doubled your assets, and you've taken out all of your initial premium. If you want to take out more, you're just going to be taxed as ordinary income.
Correct. So what we typically, and that's, I think it's important, and Frank spends a lot of time with clients on the advisory side, whether in the US or UK context. Whenever you set up a product like this in a trust or personally held, key planning questions are always, how likely is that you need to or want to access the money? Is it really for estate planning and only maybe accessed when the overall plan changes and maybe financial circumstances changed? Or is there already a plan you foresee to live from that money on retirement, whatever? Then it's very important to analyze and see, and also in line with adjusted to the investment strategy, to consider whether all the benefits are really can be delivered. For example, very simple example, if you're in the UK, invest in certain funds and keep them very long, there's no taxation until distribution. The taxation will be the same, same rate if you would take out money from a policy. So if you would have an investment strategy that is really simplifying, but if that would be the investment strategy, if the bond probably doesn't make sense. If you have investment strategy that creates a lot of income, dividends, interest, you have a lot of trading recognition, that's a very much a different question. Also the duration, because as you asked and answered was you can't offset losses and you can't do any harvesting. There's not in each case, when you analyze and advise a client properly, there's not in any case the answer that the PPLI policy or the bond will be the best solution. Sometimes you have to say, you better don't take it, because if you want to take it out in 10 years, you may have partially a tax rate conversion to the negative side. That's why we always say the investment strategies in policy should be as tax inefficient as possible, and long duration.
Mm-hmm.
Can be on the winning side after year one, and sometimes after 5-6 years. Depends where the break-even point is, depends on the strategy. That's part of good advisory, I think. To every now and then.
So the big difference here, I guess, is between U.S. and UK bond is in the U.S. upon death, it is tax free. You don't have to pay tax. Whereas in the UK bond, this is more of a tax deferral scheme, right? And at the end of the day, upon death, you're still paying any embedded taxes from the gains. Is that
on standard products that it's the case? There are product solutions but only suitable for estate planning, where you can achieve also a tax-free outcome upon death. And for example, what in the UK, what you could do is you transfer the policy during lifetime, because there's no gift tax. You just need to survive 7 years, and we can insure that risk, this inheritance tax tail. And with some additional structuring, you can transfer that to friend, family member, to your children. You can still keep control, but having this done as a completed gift, and then design it in a way that the payout at the end is tax-free. So there are certain strategies, but that's the biggest difference. If you don't do a lot of
just
planning, final taxation, no final taxation, income tax.
Yeah, Frank, why don't you expand a little bit on that?
And it really comes a couple of things. I mean, just what you mentioned previously about clients taking funds out of policies, whether in the U.S. or the U.K., what we have seen, it's the larger families and doing the larger deposits. They want to know there's access if it was needed, but they're not usually entering into these transactions to want to put the money in, get my tax benefit, and take the dollars out. I'd say from both jurisdictions, U.S., U.K., that's going to be more of the mass market policies. And even in the private placement life space, it's not the necessarily optimal planning to go into that on that side of it. To expand a little further on what Riccardo was mentioning on the UK side, depending upon the planning, again, for I'm going to say the size of the family that we're doing the planning for, we can go into a transaction where we can give them deferral during lifetime on a UK policy, but there is taxation if they take dollars out during lifetime and upon death. I would use as an example, equated to like a US annuity, where we get that deferral and tax upon death. We can also go into a separate strategy where we're going to have more limited access to funds during lifetime, but we can take advantage of that tax compounding and get a tax-free death benefit in the UK on the backside. So it depends on what structure is going to fit in best for the family's long-term goals.
Right. Okay. So go ahead, Riccardo.
Yeah, sorry. Just give you another example. So what we do quite often in the US context, UK context, in the policies, that we have an investment amount, investment component, and a very large insurance risk on top of it. Even though you would just need for tax purpose, if it would be a pure investment product, a 1% risk, people have to pay a lot of inheritance tax in the UK quite often, because The exemption amount is a few $100,000. Exempt amount is nil bait rent is the name. Nil rate band is the name in the UK. It's just a few £100,000. So if you take a few million investment account and put then 30, 40 million dollar, for example, risk on top of it, to pay then inheritance tax when they have real estate, company interest, whatever, the pure risk portion is not subject to income tax.
Right.
Only the cash value part. So rather than paying, for example, a yearly renewable term policy that typically is not available as a whole life, very few can be converted then at very costly rates, you would pay those yearly premiums on your after tax, from your after tax money. So there's a financial benefit in those models when you set up an investment account, provided somebody has a few million, have that well managed, and then we pay this high death benefit on a pre-tax basis because you just paid within the policy to serve this high death benefit. So there's then a combined financial benefit in multiple areas you can achieve. So there are a lot of applications that are not necessarily purely investment.
Got it. Yeah. So so it's matching kind of this type of policy with other structures like term policies and structured in the right way to be able to pay the taxes at the end of life. That would make the UK bond plus the new structure a tax-free upon death solution. Yeah. Great. So let's kind of, we're near the end of the pod here, and just I want to pivot to the costs of doing this. It all sounds great for any type of innovative solution, but oftentimes I find that the costs outweigh the benefits. How does costing work in private placement life insurance and UK bonds?
I mean, the cost aspect, and Frank will comment too, from our insurance company, insurance carrier perspective. Obviously, there are very different incentive models and commission fee models, depending whether you use these universal life products that are guaranteed products, or sometimes several percent are paid as closing fees to the insurance agent. Different model, and there's no really ongoing trail. The private placement world was initially developed as an institutional product, really in the 60s, where the first private placement products in the US issued. Typically, clients of those were insurance companies themselves and banks. They were the first using these kind of products. So this institutional level has been maintained. So you have a super transparent cost structure. Typically, the costs are in the basis point range. You're not talking about percentages. It's very transparent. Also, the cost of insurance, everything is laid out separately, very transparent. There are no hidden fees and cost, which clients appreciate a lot. Whether then the in detail outlined fees are liked or disliked, that's a different. There are clients that are cookie cutters and want to have all the benefits and don't want to pay anything. You have that everywhere, but generally speaking, the cost side is very, very easy to beat the tax savings. I mean, the cost typically for high net worth policies, they range 50 to 70 basis points all in. If it's really, depending on age, if the cost of insurance is maybe increased rates, maybe 80, 90 basis points, but typically they're more than 50, 60 basis points. That's the cost. And then if you compare that with investment strategies and the tax residence of the investor, they often face between 30 to 50% tax on this income and this investment. These are,
right. Those are the cost benefits that you need, analysis that you need to do in terms of cost at the end of the day, money in pocket, right?
But as mentioned before, obviously that's always needed and a fair question. Obviously, if you desire and you want to have an investment strategy that has a 15 years buy and hold strategies, the the tax benefits alone may then not be as big. So we always look on the investment strategy and calculate as detailed as possible. Obviously, there's always the simulations, but we are not friend of having just showing crazy high returns, assuming the highest tax rate and showing the maximum benefit. I mean, every client is different, so it should be really tailored. And Frank is doing a great job also in having these kind of discussions with potential clients, policyholders, to ensure that the benefits, the pure financial benefits, are verified. Apart from that, there are all these other benefits, like we mentioned, enhanced asset creditor protection, privacy on the investment level. If you go in other countries where all the civil law countries where typically policies are not held by trusts, or even in the US, if you own them directly, they're pay out of probate, right? If you're living in country A and you have an asset manager and a bank account in country B, if it can take years to get the money after this with all the probate and court and translated documentation. If you do this as a policy, no problem. The policy pays to the designated beneficiary. No court is involved. Money is not locked up for years in a foreign bank account. A lot of other benefits that are not just tax benefits, right?
Well,
Understood.
I mean, if I can just add on to that, I mean, and Riccardo is correct. I mean, let's just use over the life of a contract, we can have 50 to 70 basis point drag. One thing that's very important, I have to give Riccardo credit for this term. I mean, as we talked earlier, I mean, active investment management, and especially if someone's living in a high tax jurisdiction, is going to generate more taxation. So really, we're giving somebody the ability to have tax neutral active asset management. Now think about that for a second. So it's really going to be that tax drag that dictates this transaction. If you go into something where, and we get this at times, you get the manager comes in, it's, if I have a client, he's going to buy XYZ, big blue chip stock and hold it for 20 years. And, if he holds it personally, he'll get a step up in basis in the US. If it's in a trust, it might not. I mean, it's a whole separate conversation. But if they're not going to have active asset management, the policy might not work. But if you have something here where you're getting this as a tax blocker, that's really what clients are going into this for. I mean, another thing here is really, we don't have clients with my firm coming say, listen, I need 10, 25, $50 million of death benefit for my estate taxes. Go get me a private placement policy. This has been, I've got 10, 25, $50 million in a multi-generational trust. We want to make it tax efficient. We want to have a manager run this on a discretionary basis, and we want to look to choose the manager. We can structure that. So it really comes down to math. It's if the policy charges are less than the taxes you would pay, you're taking advantage of the tax compounding, you're in a winning situation.
Yeah, no, totally makes sense. And I guess one of the key things that, aside from cost, that often comes up is, what are the regulatory risks of somebody, or whether it's US or UK, deciding to pierce through the insurance policy and say, no, this is a tax scheme. You're going to have to pay taxes on the underlying. What are the risks of that happening from a regulatory perspective?
I want to let Riccardo answer a big part of this, but I want to add one thing. I would state that a lot of it comes to how is their transaction structured. I mean, we see people where there are some abuses out there in the marketplace where you have these, let's move, using as an example, I hear people talking about moving an operating business into a policy or an asset that they're controlling. I mean, a bad fact pattern is really going to bring that to light if a regulator's looking at that. In the greater scheme of things, I mean, insurance is there for the public good. I mean, so in the US, whether it's going to be pierced because if we have certain limits or contribution levels they want to limit it to, that's something we're going to see where it's going to go with the lawmakers. I don't believe we're going to get there. But I would just say if somebody's doing a transaction irresponsibly, that puts that transaction at risk and even the broader marketplace at risk. I mean, Riccardo, anything to add?
No, as mentioned earlier, the last time there was a big overhaul in the US taxation for life insurance taxation, and the rules was in the 80s, 84, 86. And there have been a few small amendments in betweens in the first presidency of the current president, where basically the tax rates for the insurance companies were lifted up. But apart from that, because in the US, over 50% of the population have life insurance contracts. And as mentioned, the rules are the same, whether you have a retail life insurance with cash value or a millionaire owning a larger policy. The rules are the same. And so you have hundreds, I think it was over 200 million insurance contracts in force. In the UK, there are over 20 million insurance contracts in force, life insurance contracts. So in many markets, it's always the same. There's so many in force, it's nearly impossible to touch the existing ones. So from a legislative history, when laws were changed and governments decided, okay, now for whatever reasons we want to amend the rules, there was always so far, I mean, don't promise anything for the future, everything is possible, but so far was always said, okay, the old contracts, as long as they don't modify it, they grandfathered, they benefit from old rules, every new issue from date X, Y, Z was the new rules. That's typically the way it's done. Otherwise, you create a huge mess and nightmare in the existing books. Hundreds of millions of contracts would have to be changed, amended. This unhandleable. So that's usually the way. But as Frank said, the key thing is proper contract, no aggressive structuring, work with an insurance company that knows the rules, follows the rules, that is capable of operating the contracts in a way that they don't fail. I mean, there are things like Canada has other, but somehow comparable rules. You have to maintain a certain corridor, so difference between or the amount of risk in relation to the cash value. And if you're not continuously monitoring this and ensure that the contract is staying in those rules, you break the contract and tax rules, tax privileges are gone. So there's also operationally an ongoing proper professional management to be done on contracts, interaction with clients. You know, typically what Frank would do together with us, if a portfolio would grow too fast or even the investment performance is really bad, then we would ring the bell and ensure that action is taken in whatever direction to ensure that the client is still be able to following the initial plans. So the risks are really little, but clients shouldn't be too greedy. There are people running around that promising everything. I recently found again somebody who was promoting to wrap UK real estate in an offshore bond, which is clearly nothing HMC would ever bless. And you find aggressive stuff in the US too. And the problem, the contracts, I mean, they stay long. That's typically why you take those contracts. You don't take them and cash them out after years. So they run typically many cases for estate planning. So if you do something really stupid or aggressive today, it may not hit you in 1 to 3 years, maybe in an audit in 5, 10 years, or even on the estate administration, right? And then paying back all this stuff. So the governments are very stable on this, but they don't like abuse.
Right. That totally makes sense. Now, has the UK recently updated? Wasn't there a regulatory update in the UK that you guys were paying attention to?
The biggest change was really the few hundred years old abolishment of the resident non-dom tax regime that allowed you, when you moved to the UK, you could go into this resident non-dom scheme, basically keep most of your assets outside in a foreign trust, and they will not be taxed in the UK for a number of years, and very beneficial. So you had a mix between worldwide income and territorial taxation. This has all been abolished, and that's very complicated for Americans in the UK context because they always have all these trusts. And now those become taxable in many cases, even subject to UK inheritance tax.
Oh, wow.
That's why last year, and this year before April, nearly 10,000 people left the UK, wealthy people, to escape these really drastic tax rules. And on the insurance side, there was really no change, except that for some of these trusts that were always outside UK taxation, and now very few can benefit still from this exemption, but those that holding UK offshore bonds or onshore bonds are not permitted anymore to take out money under the 5% per year rule. So they haven't changed the product rules. They just said for certain trusts, because they really wanted to abolish all these tax benefits of these offshore trusts as far as possible. They said, okay, for some of these trusts holding these policies, the tax-free withdrawal is not possible anymore. But if you own them, otherwise the contracts rules haven't changed.
Got it. Okay. Well, this has been super informative, gentlemen. I really appreciate your time. Are there any final thoughts or key takeaways that you want the listeners to remember before we go?
What I'd like to add is, planning can be very complex, especially when you get into individual jurisdictions and families in multiple jurisdictions. In general, but what we're utilizing is it's insurance. The concept is more simple of the tax benefits insurance affords, and we build that into the planning. It's the design, implementation, and ongoing administration that's more complex, and that's what we're here for. And these are long-term transactions, and just believe that clients working with the right advisors, the right companies, and staying in compliance are going to be the ones that are successful. So it's been a pleasure to be here. Thank you very much for having us. That's what I'd like to add. Riccardo, anything on your end?
Yeah, just in line what you said is really, I tried to explain that it's not so complex what the product itself is. We take together with advisors and Frank the complexity away from the asset manager and the family and do all these technical things. What is complex, nevertheless, and that we can't, that's independent from our solution. These products are typically embedded in a bigger plan, whether it's estate planning, asset protection, expatriation, immigration, all these complex structurings that are really more family planning, family governance, structuring questions. And then they're combined with the insurance and the investment side. And we often have a lot of discussions and have delays because families, when you then ask the right questions, have to sort out those things first. Technically, plugging in our things is relatively easily done, but quite often we find us in situations where the family hasn't thought out about the one or the other aspect, or even, they had a liquidity event and now they want to set up all these trusts. And then they figure out it's not so easy to think about who shall, when and why benefit from the trust and define what is descendant, what is family, is it bloodline, is it in-laws? And then sometimes they spend easily 6 months just to answer these kind of questions, which have nothing to do with our solutions, but they're a fundamental prerequisite. And we always take pressure out and really recommend and say, take your time, because these things are really the most important. It's like a foundation for a house. If this is sand, everything you build on top will collapse sooner or later unnecessarily. So that's why things are often complex, but not because PPLI is complex. And thank you for having.
That's great context. Yeah, absolutely. Planning and the foundation before you start using tactics, right? Strategy before tactics.
Yes.
I think is super important to understand. And we got gentlemen like you to help people out and provide some clarity. So where can listeners learn more about you guys, what you do, and where can they find you? Do you guys have any social media, or is it just direct to the company?
On our side, we have a website, crownglobalinsurance.com. You find myself also on LinkedIn. Just look up my name, is quite unique, and then you will find us too. And everybody who has questions is welcome to reach out, and we try to help. Thank you.
Yeah. Yes. For myself, We are just relaunching the website, which is going to be released very soon. So you can find us on the web, and also you can find me on LinkedIn as well.
Great.
All right.
Well, thanks again, gentlemen. It was a pleasure having you.
Thank
And
you.
I'm sure we'll chat again very soon.
Thank you. Look forward to it. Have a good day.
Bye-bye.
Bye-bye.
I did want to take a quick second to remind our listeners that the team works really hard on these podcasts. We spent a lot of hours trying to get the right guests, and we do a lot of prep work to make sure that we're asking the right questions. So if you do have a second, just do hit that subscribe button, hit that like button, and share with friends if you find what we're doing useful.